Santanu Sengupta, Chief India Economist at Goldman Sachs, joining us this morning. Mind you, this comes at the backdrop of the fact that Goldman Sachs and Santanu believes that there's going to be a likely downside risk to India growth and an upside risk to India inflation. And he's put out that note. Santanu, very good morning. Hi, this is Harsh here. Give us a sense, first off. Is Goldman Sachs banking on the fact that this conflict could be slightly more prolonged? Is that really the underlying of the thesis that you've put out?
Thanks for having me. Look, our commodities team is assuming the baseline is a 21-day closure of the Strait of Hormuz, where about 10% of normal flows pass, and thereafter a gradual reopening. So you have around $100 average oil during this period, and thereafter you move towards 85 odd in April, and then towards the 70s by the end of the year, which is in the second half. Now, with those underlying assumptions, we think that growth will take a dent, and this is where the shock is slightly different from the earlier ones that we have seen. India has faced terms of trade shocks from higher energy prices for the last 25 years. This time is slightly different because typically in the earlier episodes, when oil prices rise, the Middle East economy does better because it's the producer of oil. Whereas this time around, the conflict is located there, and their economies will be doing worse than what they have in the past. India is way more integrated with the region compared to 10 or 15 years back. Around 13% of our exports is to the region, 40% of our crude imports, 80% of our gas imports, and 40% of remittances, $135 billion odd of remittances last year, right? So if that part of the economy is slowing down, the terms of trade shock just gets exacerbated now with higher oil prices, which is why we think that the dent to growth is around 50 basis points. As of now, we've cut our numbers from 7% for calendar 26 to 6.5%. That would be equivalent to 6.4% for the fiscal year 27.
Santanu, I just wanted to understand, given that everything is based on the premise of where oil heads, what's your base case assumption?
So our base case is still that, as I said, that oil goes back to the 70s in the second half of the year. If it is higher than the 70s, we think there's some further downside to growth, a little bit of upside to inflation. I would be careful about characterizing our inflation numbers because the underlying assumption that we are making with this shock, both for growth and inflation impact, is that fiscal policy does a lot of the heavy lifting. I mean, you date back to the 2022 cycle, fertilizer prices go up, the government ends up spending about 50 basis points of GDP higher on fertilizer. Pump prices of petrol and diesel pretty much remains unchanged throughout the period because the OMCs absorb part of the shock, then the government cuts excise duties. We are still making those assumptions for this cycle as well. We think the OMCs take the hit for now. We think that fertilizer prices completely pass on to the fiscal account. With those assumptions, it's a 50 basis points cut on growth, about 30, 40 basis points higher inflation. But inflation is moving from a very low handle of around 2.5% towards around 4.5%. We don't think the RBI will need to react as of now. But the fiscal assumption is quite important. One last quick point I'll make before I pass it back is that, look, there's a rationing of demand that is happening right now. With the Essential Commodities Act, the government is prioritizing household cooking gas, rightly so in our view, over industrial activity. This will protect households in the near term. It'll be better for especially the base level consumer, but there will be some risks which will weigh on industrial activity, especially during this period.
Santanu, so if this were to play out for a slightly more prolonged period of time, say for example, for maybe 6 to 8 months, what happens then, especially to the 2027, 2028 kind of numbers? And what is it that happens in terms of policy? Does your policy expectation also change, especially for 2026 in a significant fashion?
Right. So the way this works out is that the fiscal account can protect for domestic growth and inflation. What you cannot protect for is the external balances. So the external balances, our current account numbers are about 1.2% of GDP. It'll be 3 times what you've seen in calendar 25. So the pressure will remain on the external account, possibly another year of negative balance of payments. If this kind of crisis drags on for longer, at some point of time, fiscal authorities have to take the decision whether to pass it on to the consumer or not. Now, within that, there is sort of a layered view, right? On fertilizer, because it passes on directly to food inflation, and that has a big cascading impact on the economy. Our assumption is that we'll be doing whatever is possible to protect fertilizer sector such that there's no pass through into food inflation. Is it possible that at some point of time, if oil prices remain at 100, beyond a quarter or more, that some pass through happens to the consumer? Yes, depending on how the government thinks about excise duties and so on. So I would just say that if this drags on for longer, the pressure is higher on the direct fiscal account of the central government, maybe a little bit on the state governments as well, because the OMCs at that point of time will start feeling the stress of keeping pump prices steady.
Right, interesting. So in addition to that, Santanu, you've predicted that the government will step in with a 0.3% of GDP in subsidies to try and cushion the blow. In an environment of widening trade deficits, weak FDI, can India really afford to spend its way out of this sort of terms of trade shock kind of situation?
Yeah, great question. I think it's about the priorities when the shock hits you, right? So I think there are two questions to be asked. Do you have a widening of the fiscal deficit, which means that you can take on this expenditure and continue to spend on some other things which you had already committed to? Or the second question is whether you keep the deficit constant and therefore you cut. Our sense is that priority spendings in this environment, it would probably be defense or the kind of infrastructure that you need for more of self-sufficiency or strategic autonomy. Those kind of spending continues on the fiscal account. And beyond that, whatever is required to absorb the fertilizer price shock or a food price shock more generally gets taken on the fiscal account so that there's no pass through onto the consumer. But beyond that, expenditure during this period, which can be deprioritized given the oil shock, is possible. Again, it's about the next fiscal year. It's too early to call. We haven't even started the fiscal year yet. But if this continues, I think the stress will continue to grow on the fiscal account more than anything else. Last point, if you pass it on to the consumer, eventually, later on in the year, maybe the second half of the fiscal year, the RBI will need to react to inflationary shocks. As of now, we don't think so. We think that the RBI stays on hold. Given the nature of the growth shock, we think that the liquidity remains benign. They continue to do some OMOs to inject liquidity because there'll be some FX outflow related liquidity drain. So financial conditions, in our view, remains benign for now. But if you really start passing it on to the consumer and it feeds into inflation, then the central bank may have to react later in the year.
Santanu, so that's one part of the piece, right? Domestically, do we pass it through? Let's look at, therefore, what happens to the current account deficit and what happens even to the fact that you'll have a weaker rupee going forward. How much will the rupee weaken, therefore? What's your view?
Look, on the current account, we think it is about 3 times what you had in calendar 25. But the important thing, which I started with, was that this shock is slightly different from the earlier oil shocks because in the earlier oil shocks, Middle East typically used to do well. And therefore, you had a bit of an offset to your higher oil imports from better exports to that region or higher remittances, which are both likely going to come under some stress this time around. We'll figure out the numbers, over a period of time. But what this means is that very likely, given the flow environment that you all are seeing, it's very likely that you'll have a second consecutive year of balance of payment deficit. Now, the starting point for both external balances and inflation is great. Low external debt to GDP, high amount of reserves, more than $700 billion. And therefore, we should be able to withstand this shock. But given this kind of widening of current account and a balance of payment deficit, our view is that the INR continues to remain under pressure, depreciates towards 95 over the 6 to 12 month period from the current levels of around 92 odd. is what we would think going forward.
Okay. And in terms of policy, very quickly, does it even globally influence policy tilt? Of course, you have the FOMC, which will come out with rates very likely unchanged. But the longer this conflict draws on for, does policy remain unchanged? Would that be the likely consensus in your opinion?
Look, globally, our economists have at least pushed out their rate easing calls, including in the US. We have pushed it out towards later in the year, or in some cases have taken off. So the nature of the shock is such that this will be slightly inflationary for global economy, depending on how much you take on the fiscal or the quasi-fiscal balance sheet. So like India, any other countries in the region also are doing ad hoc fiscal policy interventions to let it not pass on to the consumer. And then the question really comes back to what we have been discussing for now, that how long is the duration of the shock? You can do ad hoc policies for a while. If the duration of the shock is longer, it passes on to the consumer then, and that is when monetary policy really has to react. So at this point of time, what we have done globally is to push out our rate easing wherever there was rate easing calls, just push it out later in the year from earlier.
Okay, Santanu, just the last piece is with regard to the conflict itself. You've said that the base timeline that at least Goldman has estimated is around 21 days. Am I right? And how likely is it that it might actually exceed that 21 days? Have you all done any probability of how likely is that to happen?
I mean, who knows really how long this is likely? I think the base case assumption, the baseline assumption we are having is 21 days. And then there are scenarios around, whether if there's a higher duration of closure of the Strait of Hormuz, what that would mean for oil prices and so on. So that is more of sensitivities. And, I would just say that the sensitivity would take you to a bigger growth hit. And if the duration of, as I was saying, the duration of the shock extends, it becomes an inflation hit because beyond a certain point, the fiscal may not be able to take it. I think what is important to keep in mind, again, just to repeat, is that the food and the fertilizer sector gets protected first because it has a much bigger pass-through onto the consumer. And then it is, pump prices of petrol, diesel, other petroleum products, and so forth. And within that, the household is the priority, and then the industrial sector.
Within that growth that you've cut in terms of the estimate from 7 to 6.5, that 50 bips cut, could you just spell out as to what sectors will be the worst hit in terms of the growth itself?
Well, as I said, we think that some of the government capex is going to come under question now if the fiscal doesn't widen. At this point of time, it is very, very early. We haven't even gone into the next fiscal year yet. But I would say that the priority in this environment would be something like defense spending and infra spending, which is related to self-sufficiency or strategic autonomy. Everything else gets deprioritized in this environment. The second sector would be that we have generally been quite confident about the rural or the mass urban or the mass consumer recovery. The crop cycle was looking quite good until the shock hit us. The overall rural incomes were looking better. You're having transfer payments coming in from the state level onto the consumer, onto the rural consumer. You are seeing some bit of the monetary policy pass through into credit growth running at about 14% odd for consecutive months. Within that, the MSMEs or the SME sector growing quite strong. So industrial credit had recovered. So we would say that if the fiscal policy protects that leg of the consumer, we would continue to think that the mass consumer sector does okay through this environment, assuming, of course, there's no pass-through of the food inflation onto the base consumer.
Right. Santanu, last off, and I know I'm pushing this conversation, but give us a sense, therefore, that with regard to holding of prices at the pump, how long do you expect that to go on for? Just given the fact that crude has moved now nearly 50% above even RBI's estimates. For how long can we hold out with regard to prices at the pump?
Look, again, with our assumption of the 21-day closure and $100 now and then 85 and then easing off towards the 70s, we think that pump prices don't really need to change pump prices of petrol and diesel don't really need to change. OMCs take the hit for now, and if required, you can have a bit of excise duty cuts later on from the central government. This was the playbook in the 2022 cycle also, if you remember. The 2022 cycle was, protect pump prices for the time being with the OMCs, then cut excise and take the fertilizer subsidies onto your own books. We would think that is the playbook for now, for the next quarter or two. Beyond that, if prices persist, that's when we think that the requirement of pass-through to the consumer will be required. If oil prices are at like $100 odd for a couple of quarters, then for sure, I think the conversation will start in terms of how much to pass through to the consumer and how much of a fiscal hit you can take.